Alright, today I'm going to analyze the stock Turtle Beach, ticker symbol HEAR. This was recommended to me by Cory on the previous video I did. He recommended I break down Turtle Beach as well as Method Electronics. We're going to do both of those, but this time we're going to focus on Turtle Beach. So this is a great opportunity to show you what I do whenever I break down a company. If a company is recommended to me or I see a company I might be interested in researching, here's what I'll do. First, I'll go to macrotrends.net. As soon as you type it in, you go to their homepage. This is what the front page will look like. Scroll down a little bit till you see stock research. Click that and it'll take you to this page here. It'll have these top 25 US stocks by market cap, and then it'll have top stocks by volume. And then in the top right, there's a search bar. Begin typing part of the word as I did here. It automatically brings up Turtle Beach, and we're going to select net income because this will tell us if the company is profitable. After all expenses are paid, taxes are paid, research and development is spent, your equipment has depreciation on your equipment has been accounted for, your debts that you've paid, interest on those debts that you've paid, net income is what's left over after all of that. So I always look at the net income first. And here you can see that they're bringing in $30 million in the trailing 12 months. They have their quarterly down here. And for the most recent quarter, they reported $16 million net income. And you can see that they've been profitable for about a year at this point, but they are profitable. And you can see in the past where they've had huge losses. We'll figure out exactly what happened there. Scroll back up to the top, select shares outstanding. This will tell us if the company is issuing more stock in the company. Then we're going to scroll up to the top, select revenue. Revenue differs from net income. This is all of the money that the company is bringing in from sales. And we can see that they are selling, as of this last quarter, they sold $130 million worth of product. And for the previous year, as of the most recent quarter, on the top line, they sold $360 million worth of product. Scroll all the way back up to the top, select margins. Select profit margin, then it's actually given us some of the information that we want to see here below, and it actually brings up the net profit margin here to the top, 10.76%. Let's dive into it a little deeper. And this graph looks weird because in 2013 they had a net margin of negative 2,000%. So this outlier is making the rest of the graph look flat. So we're just going to click the scroll bar on the bottom there that you see at the left side, and we're going to scroll past all of that negative 2,000% margin to get something more normalized. And we'll scroll all the way up here to 2016, and we see that they still had a bad net margin of negative 82%, and so that's still an outlier skewing the rest of the graph. So if we scroll up to about 2018, looks like they still had a negative net margin of 35%. So it's still kind of skewing the graph. But we can see that after 2017, 2018, the company starts to do a lot better and we don't see any negative net margin. And if we look at the current view, this gives us a more realistic view of how they're doing. Yeah, current net margin of 10.76%. That is pretty high. So if they sell, a certain amount of product, they pay all of their debts, they pay all of the operating expenses, pay taxes. What's left over, the net income, we're going to divide that net income by the net revenue, and then we're going to divide the net income by the revenue. It's going to give us a very small number, multiplied by 100, gives us 10%. So the net margin takes into account all of the expenses because you have your net income. All right, so scroll all the way to the top, click on the Assets and Liabilities tab, and then click on the Total Assets sub-tab. And we see that their total assets are $203 million. And what's most important here to me is that they are increasing. Look at the trend line. You can see that they are trending upwards. It looks like they did technically have more assets back in 2015, 2016, and then there was a large dip that followed, and they've kind of recuperated. Let's scroll back up to the top and click on the debt. Click on the long-term debt tab. Okay, so their long-term debt looks like they have no debt. They haven't had debt since the end of 2019. And paying off that debt is a good idea. They no longer have to pay interest. So that's just extra money that they can deploy elsewhere. And then scroll back up to the top and click on total liabilities. And it looks like they have $87 million total liabilities. I'm just going to click back on the total assets. And they have $203 million in total assets. So they have more assets than they have debt and liabilities by quite a bit. So that's a positive sign. If their debts and liabilities were higher than their total assets, that's even something that banks and creditors will look at. That makes the company look more risky. So that's a good metric to look at as well. Scroll back up to the top, click on EPS. And EPS stands for earnings per share. So take your earnings, take your net income, right? So just the profit after you've paid everything. Divide that by the total number of shares. So take their net income, which we can look back and see what that is. Their net income, current net income for the quarter is $16 million. And for the last year is $36 million. So 16 for the quarter, 36 for the year, and their earnings per share. So take that earnings, that 16 million for the quarter, the 38 million for the year, divide that by the total shares that they have. And we can look back at the total shares outstanding and see that they have, I believe that's 16 million shares. So we should get an earnings per share close to $1 because we had our $16 million in profit divided by our just about 16 million shares. And we see that our earnings per share is about $1.07 on the quarterly, or $2.37 for the yearly. And I can't really tell if that's good or bad. That's just to make sure that that is being reported and positively based on what we know for the net income. But you really can't tell if earnings per share is good or bad. It really depends on the net income specifically, and it also really depends on the total number of shares. And then we're going to scroll up to the top, select price ratios, and select PE ratio. And we can see that it's displaying that their PE ratio is 12. So the PE ratio is the price to earnings ratio. It's going to be the stock price divided by the earnings per share, the EPS number. And it tells us here that Turtle Beach has a PE ratio of 12.32. And just as a rule of thumb, investors and analysts, business people in their infinite wisdom have said that 15 is kind of the tilting point for the PE ratio. Anything above 15, it's considered overvalued or expensive, and it's going to require reasonings for why it's exceeding 15. Anything below 15 is considered cheap, and also could require explanations for why it is cheap. Pretty good PE ratio for Turtle Beach. And even down here, it's saying that current PE ratio is 10.86. Depends on what stock price they're using. It depends on which EPS they're using. Are they using the trailing 12-month EPS, or are they just using 12-month or the 1 year? I don't know. And then scroll back up, click on price ratios, click on PS ratio. And the PS ratio is the stock price divided by the sales. So this should be a much smaller number than the PE ratio, because the last one, the price was being divided by the net income per share. So it ended up being a smaller number or a larger number. This one's going to be a much smaller number. And rule of thumb here is you want the price to sales ratio to be under 1. You don't want the price of the stock to be greater than your revenue and sales. And when I say the price of the stock, whatever they sell is going to definitely be higher than $25 or whatever the price of the stock is. You need to multiply this price by you need to multiply this price by the total number of shares. So if they had 16 million shares, multiply 25 by 16 million, then divide it by their revenue. And what we have is a price to sales ratio of 1.17. And it looks like it's recently increased to above 1, just about. Yeah, looks like the past 2 quarters it's been above 1. Before that it's been below 1, with the exception of sometime in 2018. But this can tell us that in regard to how much money they're bringing in, their revenue, that the price of the stock is getting a little expensive. Scroll all the way to the top, click on the financial tab, and then make sure your format is in annual. This will give us a more broader look, a broader scope of the company. We can fine tune it later. All right. So here is the total breakdown of the company. And we're going to note, I'll just start from the top. You have your revenue. And if I'm looking at revenue, I'm also going to have half my attention on the operating expenses. And, you got your income tax and you have your deductions and all of that will factor in. But if you're kind of calculating in the back of your mind, the revenue minus the operating expenses, you're going to get pretty close to your net income down here at the bottom. And then I always pay attention to the research and development. It's very exciting to invest in a company that is trying to discover new technologies, pushing the envelope. I would rather invest in a company that is spending their profits on research, developing new products, as opposed to giving out dividends or trying to make their stock look better than it is. Because then in the future, the company's not as likely to do as great. You always need to be coming up with the best new thing. And it's pretty surprising to see Turtle Beach throwing, and keep in mind here that these numbers are in millions of dollars, so they are spending $12.3 million on research and development in all of 2020. And that, as you can see, is increased significantly year over year. Then I'm going to look at the income taxes. And here they paid $13 million, almost $14 million in income tax. But the year before, 2019, you see that negative sign next to the income tax. That is actually a payment. So that's a subsidy of some sort. The company made $6 million on income taxes last year. So we could dig in deeper and find out why they were given $6 million by the government. And this year they're paying $13 million. Then down here we have the shares outstanding. We said about 16 million earlier. And that's pretty much what they're reporting here, shares outstanding. And EPS 2.37 for the year. Okay. Main takeaway here, the revenue is trending upwards since about 2015. And then take away the net income. Net income has been getting better and better since 2017 or so. And yeah, they're looking down here at the earnings per share. They've been doing a lot better since 2016. 2017 was their last year where they reported negative earnings per share. The only thing I'm seeing here is that in 2016 and 2015, it looks like they lost quite a bit of money. They have a negative earnings per share of negative $7 a share and almost negative $8 in 2015. So what I'm going to do is I'm going to click up here on the left, the format, switch from annual to quarterly, and then we're going to scroll all the way to the right. We're going to find those 2016 quarters. We're going to look for the highest earnings per share value. Well, technically the lowest, the greatest loss earnings per share that we can find. We find those to be second and third quarter 2016. So I'm going to go to Google. I'm going to type in Turtle Beach 10Q. Okay, so 10Q, that's a form. Every company reports to the SEC quarterly and annually. And this form, the 10Q, that details out their earnings for the quarter. And the 10K details out their earnings for the year. So Turtle Beach 10Q, Q3. All right, 10Q, Q3 2016. And we got Seeking Alpha up here on top. But below that, this is the actual investor relations page from the company's website itself, and they're taking you directly to their SEC filings. So let's go straight to the horse's mouth. All right, we're gonna select up here our filing year, 2016. Help us find this 10Q a lot quicker. November 15, 2016. So that's that's probably their Q4, but they'll have backwards looking statements in there. Hopefully we'll be able to find the information we want. So I'm just gonna go ahead and click on this 10Q here. Here's the first page of the 10Q, and all right, let's get into it. So I'll scroll down till I find the balance sheet. And keep in mind that all of the numbers are going to be in thousands, except if it's talking about the par value and share amount. Okay, so there's a lot going on here. I like to look at the bigger picture at first. So I'm going to come down here to the total assets. And the two columns that we're looking at, the one on the left, September 30, 2016. That's going to be the year ending September 30, 2016. And on the right, we have the year ending December 31st, 2015. So the total assets decreased by very close to half. I did the math here. It's negative 46.75%. So that's basically a 50% decline in just a year. That's pretty significant. What caused the company to lose half of its value in just 1 year? And then we have our total liabilities. We're going to scroll down and find our total liabilities. There's not enough total liabilities to account for that 50% loss. There is an increase in total liabilities, but not too much. 10,000, which is times put 3 zeros on the end of it because it's times 1,000 up here. So that's 10 million. So they increased their total liabilities by 10 million. They decreased their assets by 85 million. So that's not making up the difference. Okay, we're going to move on. We're going to find the breakdown of their income. So they have their net revenue at the top, and they're going to break down and show you exactly their costs. They go into the details of their operating expenses here, and that is going to help us get a very clear picture of the company. So they have their net revenue up top, and their cost of revenue increased by $10 million. That's a significant amount, but I'm still not seeing that 50% decrease in assets from that. Gross profit dropped in half. Selling and marketing is about the same. Research and development, that's about the same. General administrative costs, that's about the same. And I'm saying about the same, that I'm looking at the two columns on the 3 months ended. So we're seeing the most recent quarter on the left for September 30, 2016. And then we're looking at the same quarter the year before. And then if you look over here, we have goodwill and intangible asset impairment. And I'm not sure what that means, what that's referring to here. So we're going to keep that in mind, goodwill and intangible asset impairment, that phrase. And we are going to look at the rest of the earnings statement to see if we can find that called out anywhere and give us more detail. Restructuring charges, looks like $340,000. The previous year they profited from restructuring charges $173,000. Total operating expenses $46 million. Operating loss $42 million. Interest expense $1.9 million. And the net loss for the company for the 3 months ended September 30, 2016, $44.8 million. And here we have the net loss per share, 91 cents per share. So we can blame everything on the goodwill and intangible assets for the quarter doing badly, but let's do more research into what this phrase means. So I'm going to hold down the control key and press F at the same time. It's going to open up a word search for the document at the bottom left. And then here I'm going to type in goodwill and intangible. And here on the right, I'm going to see that I already have 2 of 3 matches. So I'm just going to hit enter or this down key here and sift through all dimensions of this and read up for a little bit of context until I see what I'm looking for. And it's the second mention of goodwill and intangible brings me to these 2 paragraphs. 1 paragraph for the second quarter of 2016 and 1 paragraph for the third quarter of 2016. And we start reading, and it looks like this research it looks like this product that Turtle Beach was researching, hypersound. Okay, so here they're saying that it is more likely than not that the carrying amount of hypersound reported unit is greater than its fair value. Carrying amount is cost of an asset less accumulated depreciation. Carrying amount is usually not included on the balance sheet as it must be calculated. Initial acquisition of an asset, the carrying value of that asset is the original cost of its purchase. So the ongoing cost of the project hypersound is greater than its fair value, meaning that it is costing the company more than they believe it is worth to keep around. So they utilize a market approach based primarily on market data and comparables, including the synergistic benefit for a market participant with greater resources and assumptions about industry conditions, growth rates, and profitability management believe, on and on, saying that, another company could manage this better. By synergistic benefit, this is the benefits that two firms are expected to gain when they merge or when one firm acquires another. This analysis indicated that the company's net book value exceeded its fair value, and as a result, the company recorded a $31.2 million goodwill impairment charge, which represented the entire goodwill amount for the hypersound reporting unit. Okay, so this pretty much, they reported $32 million in goodwill and intangible asset impairment, and they're saying that this move costed them $31.2 million. So it looks like here they gave away the entire program, hypersound program, to another company, which cut their assets in half, or at least for the entire 3 months ending in Q2 2016. And then down here, the second paragraph, third quarter 2016. So it says here in third quarter 2016 that they are transitioning the hypersound business into a licensing business model. So they didn't necessarily give away the program to another company. They are licensing it out. They are still collecting revenue off of it, even though it looks like they completely wrote off all of the assets with it. So let's take a look at what the hypersound project was. So it looks like they vibrate a pane of glass, and the glass can direct the sound directly to you. So if they slightly change the angle of the glass, you can no longer hear the sound. So they include a video here. They're rotating the glass on a 360 degree motor, and whenever the glass is completely perpendicular to you, the sound plays very clearly. But as soon as the pane rotates, the sound becomes dim and you can no longer hear it. It can be completely silent for the person sitting to your left or to your right. But when the panes are facing directly to you, you can hear it, they cannot. Here's a report from March 24, 2021. Turtle Beach signs hypersound commercialization agreement with AudioFly Technology. So here's them licensing out their technology to AudioFly. And it says that AudioFly will innovate hypersound IP intellectual property, including hypersound glass, into new products for commercial, retail, business, and consumer applications. So they're actually going to do something with it and release the product. Now, this partnership is structured as a strategic cooperation for both companies, or synergistic benefit, as we saw. Turtle Beach will receive revenue sharing for all hypersound-based products. One certain objective at met, AudioFly will have the option to fully acquire the hypersound intellectual property from Turtle Beach Corporation. So once Turtle Beach receives a certain revenue number from hypersound, and they believe that their investment in research development and all these assets have been paid off by AudioFly, AudioFly will have the option to fully acquire the program from Turtle Beach Corporation, no longer be paying licensing fees, I assume. And here's a even older report. October 18, 2017, Turtle Beach announces new Hypersound Pro audio licensing agreement with the Wave System. Wave System was a French company. They wanted to use the Hypersound directed audio technology in commercial applications like retail, museum exhibits, meeting halls, kiosks. The agreement provides for an upfront licensing fee and a per unit royalty fee. But as we can tell by the 24th of March 2021 report, they have likely canceled this agreement agreement with Wave System and exclusively working with Oddfly because they offered to give Oddfly the option to fully purchase the intellectual property from Turtle Beach in the future once they meet certain objectives. And I tried to find any sort of hypersound product from Oddfly or from Wave System. The only one that I could find was the Wave System model in France. They didn't have the glass panel speakers. They just have these aluminum framed, it's kind of like a net mesh material in the center. And here are the specifications for all of it. From how it sounds, it works in the same way as the glass pane, just less aesthetically pleasing. Okay, and here is a breakdown of the revenue per program at Turtle Beach. So you can see that their headset revenue accounted for pretty much all of the revenue, $38 million, and Hypersound accounted for $101,000. But if you look at the bottom here, we have the total assets. So before they got rid of their Hypersound project in-house, they had $33 million worth of Hypersound intellectual property and assets. And they had $90.7 million in assets like intellectual property in their headsets. So look back their revenues, and you can see that the headsets brought in just about a third of the value compared to their assets. And Hypersound brought in less than 1%. So they have this $33 million in assets, and Hypersound, all this research that's gone into it, yet they only brought in $101,000 in revenue. They're looking at this on their balance sheet, and they're thinking they are not getting a return on their asset. They have all this money being poured into this program, and it's really not doing anything for them. So they work up a deal with another company, try to get some revenue coming in for that investment they've made. And here we see some of their losses here. Business model transition charge. They've spent $7 million to transition their business to that licensing model. So they spent $7 million trying to put together a package to license the Hypersound project out. And then their impairment charge here, $32 million worth of assets that they wrote off. Value of the Hypersound program. And then if you scroll down in the earnings report, there's disclosures. This kind of explains the goodwill and impairment charge. It's interesting here, during 2015, their three largest individual customers accounted for approximately 47% of their gross sales in the aggregate. Nearly half of the company's sales came from three individuals. And then here they're giving you a disclaimer that the loss of any of those individuals would significantly impact their company. Here they disclose that they rely on a limited number of third parties. So any impact to their suppliers would give them supply shortages and affect their ability to deliver goods to the customers. Here they're giving you a little bit of context that right before Microsoft releases the new Xbox or Sony releases the new PlayStation, Nintendo releases a new system, whether that's the Switch or the Wii U, historically they have lost sales going into the new release of a platform. And they go on to explain because customers are waiting for the newest platform to come out, they don't want to buy something that has incompatible hardware and incompatible software. So they're going to hold out from buying accessories until they obtain the new unit. And here they're saying that they license out intellectual property from other companies. Okay, that's pretty much the end of that quarterly report. So then we're going to go back to the main page and search for the most recent 10Q for the quarter, or you can look at the annual form, the 10K, and it looks like that's all they have available here is the 10K. So I'm going to go ahead and open that document. Okay, and the first thing I see on this financial statement on the 10K is that there are these numbers next to some of the years. And here in 2016, there's a 2 in parentheses. I'm going to look down at the bottom of the financial report and see that a 2 indicates a $7.1 million charge for inventory reserves associated with the Hypersound restructuring, goodwill, and other tangible impairment charges of $63.2 million. So on the last 10Q we saw they were accounted for $32 million. Turns out the entire goodwill and intangible impairment charges was $63.2 million. All right, and then 2019 they acquired Realcat, which contributed revenue of $14.4 million in the year and $23.9 million total assets on the date of acquisition. And I'm sure they'll get into that a little more. And I see here that looking back in the years, they were slowly paying off debt after Chapter 2017, and here in 2020 they reported to have no debt. They're debt free, so they're not going to be making debt payments. They're not going to be accruing interest. And here on the revenue statement, we see that their interest expense has been dropping from 2018 to now this year 2020, or the previous year 2020, being $467,000, and before in 2018 that was $5.3 million a year. So you see how that interest kind of adds up time. And here we have the operating expense breakdown. Selling and marketing getting more expensive. Research and development, they almost doubled their research and development funds from 2019 to 2020, and we see abnormally high acquisition integration costs in 2019. But if you remember in the financial statement, that was from acquiring Realcat, and there's still some residual acquisition integration costs in 2020. And then here, research and development, they're gonna have a subparagraph that explains where their research development is going towards. So they invested $12.3 million into the expansion of PC accessories development capability and these stealth programs for wireless gaming headsets for the most recent Xbox and PlayStation 5 platforms. And in 2018-2019, they go into detail on their research development expenses, and they had an income tax benefit in 2019 for $6.2 million. Then their liquidity and capital resources, this breakdown here is for their cash and cash equivalents. They increased their cash and cash equivalents by $38 million in 2020. Investing activities, they used $5.7 million to develop in-store advertising displays, new product manufacturing tooling, and internal system upgrades. And they talk about their common stock issuance. And on August 7, 2020, they entered into a sales agreement with Bank of America Securities, and the company reserves the right to sell from time to time shares of their stock, par value less than 1 cent per share, having an aggregate offering price up to $30 million. And the company intends to use this money to support its strategic growth plans as well as for general corporate purposes. And in all of 2020, the company sold a total of 237,000 shares of its stock in this agreement, and they sold at an average gross price of $18.39 per share. Net proceeds of $4.4 million. And as of August 7th, 2020, price of those shares, whenever they were going into this agreement, price of the stock was $18.37. So this is pretty close to the average price of the stock. That's good to see. Sometimes they'll sell it for way less than what the stock is trading at. But after this happened, the stock fell to $16.49 per share. And then here we see some of the stock-based compensation reflected in the balance sheet. This article details Turtle Beach's acquisition of Realcat. On June 3rd, 2019, Turtle Beach acquired Realcat, which is a leading German PC peripherals business with a history of producing award-winning gaming keyboards, mice, and other PC accessories. Turtle Beach most likely being interested in the gaming headsets. So here we go. Turtle Beach's acquisition of Realcat marks the beginning of the next phase in the company's expansion into the massive $2.9 billion market for PC gaming headsets. Gaming headsets, mice, and keyboards, and is a key step in its goal of building a $100 million PC gaming accessory business in the coming years. And they're just now getting into the PC gaming accessories business. The company right now has a market cap of $460 million, and they say here they have a goal of building a $100 million PC gaming accessories business. So at the time of recording, their market cap is $398 million. So just by acquiring Realcat, and if they were to achieve this goal of building a $100 million PC gaming accessories business, they would increase their market cap theoretically by just about 25%. Turtle Beach acquired Realcat for $15.6 million in cash, plus up to $3.3 million in earn-out payments. The company expects revenues from Realcat products to be well over $30 million in 2020. So in 2020, they expect their $15.6 million investment into the company to double, and they have a goal of building a $100 million PC gaming accessories business in the coming years. So they say coming years. I wish they would have given us a timeline there. Here they are extremely enthusiastic about the Realcat expansion. They've set records as our most pre-ordered PC product. They are over-delivering on performance performance, precision, comfort, and value. They're saying 2019 overall was a decline from 2018, nearly in half, well, a little bit more than half. They blame this on the Fortnite Battle Royale craze-driven record levels in the prior year and certain initial investments in acquiring Realcat. So they blame these two things on their decline year over year of their adjusted EBITDA. In 2019, revenues related to Realcat products was $14.4 million. So they acquired the company for $15 million, and the year that they acquired it, the revenue was $14.4 million from them, and then 2020 the revenue was $30 million from them. So it turned out to be a pretty good bet on the company's part. And that'll wrap it up. Here are my sources. I'll put these in the description. Please feel free to visit these sources, do your own research, and correct me where I am wrong. Thank you for watching.